The early 1990s witnessed an unprecedented economic boom in Southeast Asia. Countries like Thailand, Indonesia, Malaysia, and South Korea, dubbed the Asian Tigers, were experiencing rapid growth. Foreign investment poured in, attracted by their dynamic economies and pro-business policies. Gleaming skyscrapers pierced the sky, a testament to their newfound prosperity. There was a palpable sense of optimism, a belief that this economic miracle would endure. From bustling factories to burgeoning stock markets, the signs of growth were everywhere. Double-digit GDP growth rates became the norm, not the exception. The world looked on in awe, marveling at the Asian economic miracle unfolding before their eyes. These were nations on the move, seemingly destined for superpower status. The future looked incredibly bright. However, beneath this veneer of success, trouble was brewing. The rapid influx of foreign capital led to inflated asset prices, particularly in real estate. Financial systems, while rapidly expanding, lacked the maturity and regulatory oversight to manage such massive capital flows effectively. Warning signs like rising debt levels and current account deficits were largely ignored in the euphoria of the boom. The economies of Southeast Asia, while exhibiting remarkable growth, were becoming increasingly reliant on hot money short-term, speculative investments that could vanish as quickly as they arrived. This dependence on volatile capital flows made them vulnerable to sudden shifts in investor sentiment. The stage was set for a dramatic fall. Despite the outward signs of prosperity, several underlying vulnerabilities plagued the Asian tiger economies. One significant factor was the prevalence of crony capitalism, where close relationships between businesses and government officials led to favoritism and a lack of transparency. This system, while seemingly beneficial in the short term, bred inefficiency and corruption, weakening the foundation of these economies. Another critical issue was the lack of robust financial regulation. The rapid influx of foreign capital fueled a lending boom, with banks often making risky loans without adequate oversight. This created a bubble in asset prices, particularly in real estate and stock markets. When the bubble eventually burst, it would have devastating consequences. Furthermore, many Asian economies had pegged their currencies to the US dollar, which was strengthening at the time. While this initially provided stability and attracted foreign investment, it also made their exports less competitive. As the US dollar appreciated, Asian exports became more expensive, hurting their trade balances. The combination of these factors, crony capitalism, weak financial regulation, and fixed exchange rates, created a ticking time bomb. The Asian tiger economies were living on borrowed time, and it was only a matter of time before the bubble burst. The crisis began in Thailand, triggered by a confluence of factors that exposed the country's underlying economic vulnerabilities. Years of rapid growth fueled by foreign borrowing had led to a mountain of debt, much of it denominated in foreign currencies. When the Thai property market began to cool in the mid-1990s, concerns arose about the ability of borrowers to repay their debts. As doubts crept in about Thailand's economic stability, currency speculators sensed an opportunity. They began betting against the Thai baht, putting downward pressure on the currency. The Thai government, determined to defend its currency peg to the US dollar, spent billions in foreign reserves trying to prop up the baht. However, their efforts proved futile. On July 2, 1997, the Thai government was forced to abandon its defense of the baht and allow it to float freely. The baht immediately went into freefall, losing as much as 20% of its value in a single day. The devaluation sent shockwaves throughout the region, as investors realized that other Asian economies shared many of Thailand's vulnerabilities. The Asian financial crisis had begun. The collapse of the Thai baht triggered a contagion effect across Southeast Asia. Investors, fearing that other countries might be next, began pulling their money out of the region. Stock markets crashed, currencies plummeted, and economies went into a tailspin. The crisis quickly spread to Indonesia, Malaysia, South Korea, and even as far as Hong Kong and Russia. The human cost of the crisis was immense. Millions of people lost their jobs as companies went bankrupt, or were forced to lay off workers. Poverty rates soared, and social unrest became widespread. In Indonesia, the crisis led to the downfall of President Suharto, ending his 31-year rule. The crisis exposed the dark side of globalization, demonstrating how quickly economic turmoil in one part of the world could spread to others. The International Monetary Fund, IMF, stepped in to provide bailout packages to several affected countries, including Thailand, Indonesia, and South Korea. However, the IMF's intervention came with stringent conditions, including austerity measures and structural reforms, which were often unpopular and deepened the economic pain in the short term.